On a Tuesday morning in March, Daniel Whitcombe walked into a bank branch in Leicester with £14,000 in cash in a supermarket carrier bag. He wasn't a criminal, he was a groundworks contractor. Driveways, patios, drainage. He'd just finished a job for a customer who'd insisted on paying cash. Daniel didn't love it, but the money was legitimate. He'd invoiced for it. He'd already logged it in his books. There was just one thing nagging at him. He'd read somewhere, a forum, a comment, he couldn't remember where, that if you deposit more than £10,000, the bank has to report you. So he didn't deposit 14,000. He deposited 4,800 that Tuesday, 4,900 on the Friday, and the last 3,300 the following week. He declared all of it on his tax return. He paid every pound of tax he owed on it. 9 months later, a letter arrived from HMRC. Here's what makes Daniel's story worth the next 15 minutes of your time. He didn't hide the income. He didn't evade a penny. By the letter of the law, he had done absolutely nothing wrong. And he still ended up inside an HMRC compliance check that ran for 7 months. It cost him just under £4,000 in professional fees and concluded with him owing exactly 0 additional tax, because the rule he was so carefully trying to obey doesn't exist. The £10,000 rule does not exist in the United Kingdom. It never has. It's an American law. And in his effort to comply with it, Daniel did the one thing that raises a red flag. HMRC's data system now holds more than 55 billion individual items of information about UK taxpayers. Last year, it brought in an extra £4.6 billion. But here's what nobody tells you. The thing that flagged Daniel wasn't the amount of money, it was the shape of it. To understand why Daniel got caught, you have to understand where the £10,000 rule actually comes from. In 1970, the US Congress passed the Bank Secrecy Act. It required American banks to file a currency transaction report for any cash transaction over $10,000. No suspicion required, no judgment call. A number crosses a line, a form gets filed. That law traveled through films, through television, through internet forums until millions of people, including here in Britain, absorbed it as common sense. Stay under 10,000 and you're invisible. Britain built something completely different. Our system doesn't run on thresholds, it runs on suspicion. Under the Proceeds of Crime Act, a UK bank has no obligation to report a transaction simply because it is large. What it is legally compelled to do is report anything it finds suspicious, any amount, any time. And that report goes to the National Crime Agency. Then, in 2010, HMRC switched on the other half of the machine, a data matching system built with BAE systems called Connect. Here's the trap, and once you see it, you cannot unsee it. If there is no threshold, then there is no safe harbor. In America, $10,000 is a line. Below the line, a certain kind of scrutiny simply doesn't happen. In Britain, there is no line, which means there is nothing to hide behind and nothing to aim just below. Every deposit you make is not measured against a number. It is measured against you, against your pattern, against what a business like yours in a sector like yours would normally be expected to do. Which brings us to the most dangerous word in this entire subject, structuring. Structuring is the deliberate breaking up of one sum of money into several smaller ones in order to stay beneath a reporting threshold. It is one of the oldest, best documented, most heavily monitored patterns in financial crime. Every bank is trained to look for it, not because of the money, because of the intent. And this is the cruelty of Daniel's position. He wasn't laundering anything. He was trying to be careful. He was trying not to cause trouble. But a monitoring algorithm cannot see his intention. It can only see 3 deposits inside 10 days, landing suspiciously close to a threshold that doesn't exist. To the algorithm, Daniel looked exactly like a man with something to hide. If he had simply walked in and deposited the full 14,000, nothing would have happened. The second half of the trap is the silence. Because that suspicious activity report goes to the NCA and not to your tax office, nobody tells you. Your bank cannot tell you. In most cases, it is a criminal offense for them to do so. That is why Daniel heard nothing for 9 months. He assumed he'd got away with something. He hadn't. He had simply entered a queue. And one more thing. When your bank phones you and asks where a £5,000 deposit came from, that is not the law either. There is no £5,000 legal threshold. That is the bank's own internal policy, set by its own appetite for risk, which is exactly why the number is different at every bank and why it changes without warning. So the honest answer to how much can I deposit is nobody can tell you. And anyone who gives you a number is selling you a myth. Let's follow the chain from Daniel's carrier bag to the letter on his doormat. 4 links. Link 1, the bank. Every business account in Britain sits inside a transaction monitoring system. It's a model asking, does today look like your normal? Daniel's normal was card payments and bank transfers. 3 near identical cash deposits inside 10 days was not his normal. Link 2, the suspicious activity report. The bank files it with the National Crime Agency. Daniel is told nothing. Link 3, intelligence sharing. The National Crime Agency is not a tax authority, but it shares intelligence, and HMRC is one of the bodies it shares with. Link 4, Connect. And this is where it gets serious for business owners. Connect pulls data from more than 30 separate sources: banks, employers, companies' house, the land registry, the DVLA, card processors and online platforms, and tax authorities in more than 100 countries under the Common Reporting Standard. Since January, it also receives crypto data under the new Crypto Asset Reporting Framework. Connect doesn't just store all that, it scores it. It builds a picture of your financial life and compares it against the story you told on your tax return. Where the two disagree, you get a risk score. And that score doesn't sit on a single return. It follows you across your companies, properties, and joint accounts. Now, there are 2 things Connect is not. It is not a decision maker, a human decides, and it is not omniscient. It works on metadata, not on substance. It cannot see the invoice in your filing cabinet that explains everything, which is precisely why that invoice is your entire defense. Under Schedule 36, HMRC can demand your records, and since 2021, the financial institution notice lets them go directly to your bank without your consent. I want to be fair here. These notices are still rare. This is not mass surveillance of your current account. HMRC is not reading your banking app. But that is the point business owners miss. The question was never whether HMRC can see everything. The question is whether HMRC has a reason to look. Notice what all 3 have in common. Not one of them set out to cheat anybody. Every single one of them lost money because their bank account told a story their paperwork couldn't back up. Case 2. Priya, a cafe owner, turning over around £190,000 a year in a cash-heavy trade. Priya banks most of her takings, but she pays suppliers in cash straight out of the till. That money never touches the bank, but it's in her books. But Connect doesn't read her books. It sees her card takings and the cash she banked. Her ratio of cash to card is unusually low for her sector. That is the flag. HMRC opens a check and forms its own view of what her real takings must have been. And now the burden has quietly inverted. Priya must prove them wrong. Case 3. Tom, a limited company director running a consultancy, turning over £300,000. Tom is not evading anything, but his company account and his personal account behave like one wallet. 25,000 moves out for a house deposit and drifts back in later. HMRC sees a director using company money as a personal overdraft, which opens the door to a Section 455 charge, a benefit in kind, and an expensive argument. So how do you protect yourself? 5 action steps. 1. Stop managing the number. If you're banking 14,000, bank 14,000. 1 day, 1 transaction. 2. Build the source of funds file before anyone asks for it. For any unusual money, put 1 page in a folder on the day it happens. 2 years later, memory is worthless. 3. Separate your accounts, ruthlessly, no exceptions. Every time you blur that line, you hand HMRC a reason to ask for your personal statements too. 4. Document directors' loan movements on the day they happen. A board minute, a dividend voucher. Your accountant cannot manufacture intention 9 months later. 5. Before you file, reconcile your return against what HMRC already knows. Platforms, banks, land registry. Where they disagree, you need an explanation ready. The only protection left is coherence, making sure that what your bank says, what the platforms say, and what you say about yourself are all the same thing. Nothing in this video is personal tax advice. Speak to a qualified accountant. If this was useful, subscribe. I break down what accountants charge £300 an hour to explain for free. Next week, we go somewhere that has caught thousands off guard. Crypto reporting to HMRC. I'll see you there.